Hello, welcome back. So we're taking a look at HPQ, one of the companies that I really like, and it's down again today about 5% with the rest of the stock market after we got the jobs report and unemployment is lower than expected. This doesn't really help inflation, a tight job market that is, and so we are looking at a lot of companies actually crashing once more. Now, HP here is a company that you just can't be avoiding. You'll see here that its 1 year high has been at about $41, which is like 40% down from its current price. Now, this company is amazing in with their numbers here. You will see that their P ratio is 4.5, the price to free cash flow again at a similar level and pretty much dropping, continuously dropping. Outstanding shares that keep going down because the company has been spending tons to actually buy back shares. And you will see here that the total liabilities compared to free cash flow is a little bit more elevated than we would want it to be. But we will examine that in more detail, see whether that's a potential issue. Now, in terms of the revenue growth of the company, this has been growing. It's already a pretty big company, as you'll see, in the many billions. So you can be expecting insane amounts of increases here in the revenue. But overall, it has been growing pretty nicely, regardless. Now, in terms of 5 year net income growth here, you will see again pretty nice increase here, more than 100%. Same thing with free cash flow growth, very nice increase, and total equity that has been increasing, although it's in negative territory, and that has a lot to do with the fact that the company is buying back a ton of shares. So while this may sound like it's a bad thing, it could actually be a good thing because the company has been buying back cheap shares of their stock as it's going down right now. Now, the net income margins of the company are sitting at about 10%, with returns lately being in negative territory. This is the latest quarters, pretty much, and so things are getting a little bit worse in terms of what the company is doing financially, and that you see that with a lot of companies right now, and so this is one of the core reasons why you are able to potentially get those at a cheaper price. Otherwise, they would keep pretty much climbing. Just because this return on equity may sound intimidating, I can quickly tell you a few things about the equity of the company, which you can kind of see it here. It's in negative territory. That's why you're seeing a negative value here. But is it really an issue? Is the thing, because remember the company has been buying back tons of shares, so they do that on purpose. Otherwise, they didn't have to. They didn't have to spend tons of money to actually buy back common stock. And this is what they have been doing lately. They have been actually spending a ton of money buying back a ton of shares. And this is why you're looking at negative equity here. But what we do really want to see here is what happens with the financials of the company, because if they actually do that on purpose, that's not a big deal. It's not a big issue. Because if the company is generating nice profitability and actually spending that profitability in order to buy back cheap shares, which they deem cheap, this is actually good for shareholders. Again, as long as the operations are actually fair and they are doing well in terms of their money making machine. And you will see that the revenue has been increasing nicely. And what we care about is the net income, which has also been increasing. Now, they did have a drop back in 2018, but lately they have been increasing, and quite a lot at that too. In terms of the cash flow, which is always very, very important here, you will see very nice operating cash flow here, 6.4 million, which is a billion, which is about the same as the net income. Pretty nice to see. And if you take it down to the free cash flow of the company, 5.8, that's nothing to sneeze at. That's very, very easy for the company to actually pay back their shareholders their dividend, pretty much, because you see they pay 1 billion here, and also keep money for themselves and start generating more total assets, buying back even more shares. So that's actually a good thing. And this is what you're looking at here, common stock repurchase. Take a look at these repurchases here. I like to see that as a shareholder, no doubt, especially if the company is good with making money. And if you go back to our stock tool here, of course, you can use our stock tool to do a full-blown analysis. You will see 26 billion of its market cap, and the company made about 6 billion in free cash flow last year, which, as you see, is about 5 in terms of their price to free cash flow ratio, which is great. It's absolutely great to see. The company is also paying a pretty hefty dividend here, which is about 4% with a free cash flow payout ratio. We saw it earlier. Remember, it was like 1 billion out of 6, so it's about 20%, a little bit less. Same with the payout ratio when you compare it to the net income. So things are looking very nice here. This is a company that I really, really like what I'm seeing from. And if we take a look at the stock evaluation tool, we will of course decide what kind of price it makes sense to be paying for the company. But first things first, let's examine the dividends a little bit. So you will see that the company has been growing the dividends pretty precipitously, paying 4% right now. And the thing is, they are paying it out very easily, as we saw. Like the payout ratios are very low, so this is a very safe dividend, likely for many years, if not pretty much for decades to come. And so this is something that I love to see, because something that is very important when you are buying dividend companies. Of course, I have told you that they are taxed twice, and this is one of the reasons why I don't like them. They also extract cash from the company, but in an inflationary environment, which is more risky, which is riskier, generally speaking, it may be just a little bit of a good idea to get a little bit of a dividend back, pay yourself back a little bit, because you are removing some of the risk. Like if you hold this company for, let's just say, 10 years, now you're getting paid 40% of your initial purchase value. And this decreases your risk, because again, you are making money back on your investment regardless of how the stock is doing. And if the stock is actually going upwards, then that's even better for you, of course. The bad thing about these dividends is that these kinds of companies, because they're paying out dividends, they don't tend to be growing their stock price that much. So it tends to trade at a sort of like range here. And so if it goes down a little bit more, maybe it goes back to 40 or so. Going past 40 may be a little bit tougher, I suppose, but it could still happen. It would eventually happen through the years. So you definitely want to be buying these kinds of stocks as low as possible. So if it reaches 20, that's then even better, of course. Now, does it make sense to be purchasing some right now and maybe averaging down as it goes down? We'll see. We will examine that with our stock evaluation tool next to see what kind of price it makes sense to be paying for this one. Now, in terms of insider trades, things look rather normal here. Remember, it's always useful to see whether there are purchases in green, because it means that somebody actually paid their own money to buy stock. It doesn't happen here. But then the other thing that is interesting to examine, and I always like to be taking a quick look, is whether the chief financial officer is actually selling a lot of securities here as a percentage of their total securities owned. So if they are selling out of everything, then it may be a little bit of a dire thing. Now, if they are selling part of it, and especially if it's given away to them for free, then it means that it's part of their compensation. This is normal. Something like this, for example, looks rather normal, because the person, the chief financial officer, still owes quite some. Now, they did sell a lot here, as you'll see. Like, these are some significant sales here, starting from, as you'll see, it goes through here, like 28,000, and they went down to 13,000 over here. But you you also want to be taking a look at the stock price, because when they sold, that's a good price to sell, 36, 39, 33 even, because this is the ceiling. Like, remember, if we go back and we take a look at our chart over here, the 5 years chart, you'll see that this is almost like the ceiling here, near 40. This is where I would sell as well. Like, if I got it at maybe 25 and then it went 40, I would more than likely sell the stock, frankly. Again, this is because it is trading at a ceiling, it is trading at a range. These kinds of companies do that a lot. The dividend-based companies, you do want to buy them low, and then when they reach the ceiling, potentially maybe give them away and make some money out of that exchange, pretty much. Of course, something could be said for holding them and gaining the dividends, but it's a different way of handling things. Like, if you really want to get a safe dividend overall, that's fine to keep to keep them going. But frankly, for me, if I can pocket this kind of increase, which is very substantial, frankly, it's almost 100%, then I would definitely go for it. In terms of senator trades, I always kind of take a little bit of a look at that. Something interesting here is just a little bit of purchasing over here, selling before that, but purchasing lately, as you'll see. That was the transaction was made June 2nd, so it's still a few months ago. Okay, interesting things to see for the company, but what about the stock evaluation tool? What do we get out of that one? Now, the company has been growing at an average of 5% a year, pretty much. And they did the best year last year. No, so what are we going to be using now? So for the next couple of years or so, the company could even reach a negative territory in terms of revenue growth. So I would like to go in the negative, or at least start in the negative here. Maybe make it a -5, then -3, and then 3, and see what we get out of, or maybe -2 here. See what we get out of that, in case the company keeps declining in terms of revenue growth. And of course, -5% a year, I don't think it's going to happen. This is a very pessimistic scenario, but let's just try that out. In terms of margins, the company does about 10% lately, as you'll see. They seem to be doing about 10% lately. So I'm going to go 8, 9, and 10. Maybe the margins drop a little bit. The free cash flow over here, the free cash flow margins are sitting at about close to maybe 100%. It's somewhere in between, frankly. So for this one, I'm gonna go, let's just go 90, 100, and 110, quite a few years, more than 100, and annual return of 13%. So what do we get out of this? And so easily, comfortably in green territory, even for a minus 5% revenue growth, so a revenue decline pretty much, still very, very comfortably in the green over here. And of course, if we go like 3%, this is massively, massively in the green. And this is because the company is super cheap compared to the free cash flow that it has been generating. It has been generating a ton. It's like 5 times its free cash flow. It's like 5 times free cash flow. It's its whole market cap. And so, as you can understand, the current price of the stock is cheap based on what they are generating. And even if they decline a little bit, they are still a solid buy. And the fact that their dividend is so nice over here and so easy to pay for them. Again, even if their net income and free cash flow declines a lot, they would still be very, very easily able to pay this one. So very unlikely that they will be cutting down on dividends even in any recessionary environment. And so this one may be a very, very solid buy. This is why I added this to my online portfolio. And today, even down 5%, it may even be another even greater of a buy. Okay, so thank you for watching. Tell me what you think about HP. And remember to leave a like and subscribe, and I'll see you in the next video. Take a look at this other one that I made earlier as well. And this one is talking about Tilray and the current cannabis market, what's happening over there. And I'll see you in the next one. Bye-bye.